29,346 pages, 21,000 transactions. That's what Bloomberg's Brad Keoun had to wade through to bring us this blockbuster revelation about the Fed and its role as a backstop for the global financial system. The Fed put as much as $1.2 trillion of public money at risk in secret loans. The recipients, the world's largest banks. Brad is here on the Inside Track, and so is Charles Peabody, a bank analyst at Portales Partners, one of the most accurate forecasters on the financial industry, making him a Bloomberg best. And so is our economics editor, Michael McKee. Gentlemen, welcome to all of you. Charlie, I want to start with you. Brad, we'll get to you in just a second because you've done some extraordinary work here. But Neil Barofsky was just on talking about how this is all about transparency, the uncomfortable transparency that the Fed is getting used to. And it's a wonderful thing that now we actually have access to these documents. What I want to know, or the information, because it wasn't just the documents, what does it tell you about these institutions? Are you surprised that at its worst, Morgan Stanley was in hock to the Fed for $107 billion?
Well, I was surprised by that number. The $1.2 trillion number obviously had been revealed earlier. But it confirms what we as analysts are struggling with, is the opaqueness of this funding market, the data lag that comes with disclosure, and the lack of detail that we get at the moment. So it makes our job very difficult. I commend Bloomberg on getting this data to the
Your job
marketplace.
made all that much more difficult, not just by the silence from the Fed, but the silence from these banks themselves. I don't recall a statement from Morgan Stanley on September the 29th of 2008 saying, hey, we borrowed $107 billion from the Fed.
No, in fact, they were touting their $9 billion capital infusion from Mitsubishi UFJ. But if you go back to that period of time, there were certain circumstances that make these numbers plausible today. I mean, John Mack had made some very derogatory comments about hedge funds and short sellers, which caused the prime brokerage clients to leave. There were concerns about the hole in Morgan Stanley's balance sheet from the commercial real estate, and then the Lehman bankruptcy made counterparties worry. So it's understandable in hindsight. But we would have loved more detail at that time.
Well, Brad, one thing that stands out is that there was a big debate in that period about whether we should nationalize the banks. In effect, the Fed was doing that without getting any operational control. But how much of this was because the Fed was just the cheapest funding source as opposed to their inability to raise funds elsewhere?
Well, it all comes back to the philosophy behind what the Fed was doing at that time, which was acting in its role as the lender of last resort. And this goes back to a banker slash journalist slash philosopher from the 19th century. His name was Walter Bagehot. And his theory was that in a crisis, you should lend freely to solvent institutions against good collateral. And essentially, this was what they were doing. This is exactly what Bernanke was doing. He was just pumping as much liquidity.
Were these solvent institutions?
Or was it good collateral? I mean, one of the things that Brad revealed in his story was that they were lending against level 3 assets, which have no observable market values, no models to value them. And the over-lending or the collateral was only like a 10% margin, which is not significant for level 3 assets.
Now that I want to ask a question to the three of you, in fact. Now that we know about this, now that Brad, you and Phil Kuntz, your colleagues, have dug through all this information, we know how it worked, we know who received the money. Could the Fed ever do it again? Would the Fed ever do it again? And if they did, it kind of feels to me as though it would have to look a whole lot different.
They would if they could. It's going to be harder under Dodd-Frank. They have a little bit less power to set up these kinds of loan programs. The real question, I guess, Charlie, is how have the banks changed their funding? Is this going to be needed in the future? Could you see a situation like we saw in 2008, 2009?
Well, the U.S. banks come into this period with much greater liquidity, twice the liquidity they did back in 2008. They're much better capitalized. Their loan reserves are significantly higher, and their balance sheet has been significantly de-risked. So the U.S. banks are in pretty good shape. And you see that in the LIBOR OIS spread relative to the Euribor, which is the European interbank lending, to the OIS spread. That's starting to show strains. But interesting, if you look at the H8, which came out on Friday, which is a Fed statistical release, it shows that time deposits for European banks here in the U.S. are declining, which is the prime money market funds pulling their funds. But banks lending from U.S. banks to foreign banks here in the U.S. is actually rising. And I think that's...
What is that telling you?
Well, there are different motivations. The prime reserve funds are motivated to give back $1 for every 100 cents they take in. The U.S. banks have a profit motivation, and so they're doing a risk-assessed return. And they think that I think they're concluding that the risks are not as great as the marketplace is concerned about.
Brad, the banks all seem to, most of them, not want to comment about this. But what was the general takeaway from them about where they are now?
Well, as Charlie was saying, liquidity is much, much greater than it was going into the last crisis. For example, just this morning, I was looking at Bank of America's cash. They had $117 billion of cash on their balance sheet as of June 30th. And our project shows that the amount they borrowed in the worst of their crisis was $91.4 billion. So if you sort of look and say that, okay, that was the benchmark, then you can say, all right, well, they should have enough liquidity, cash on their balance sheets. That's not even including all of the securities that they would consider to be liquid securities that they could sell to free up even more cash. So the question is whether this crisis will be like the last crisis, or whether this crisis will be worse than the last crisis, or whether something else happens that might change all those calculations.
I'm afraid we have to leave it there, gentlemen. Charlie, thank you so much for being here. Charles Peabody of Portales Partners. I'm getting my P's confused. And, of course, Brad Keoun doing some extraordinary work at Bloomberg News. And our economics editor, Michael McKee here, our resident expert on the Fed. Some amazing coverage. Please, folks, take some time today and check out Bloomberg.com to read more of Brad's work and those of his colleagues on what we're calling here secrets of the Fed.